Pause. Seriously, pause everything. Put the coffee down before you spill it on your keyboard, close the other tabs, and look at one number. The silver price on your screen. Go ahead? I'll wait. What does it say? $70-something. 71, 72, maybe 73 if you're feeling optimistic today. And right now, millions of people are nodding at that number like it's the truth, like it's gravity, like it's carved into stone tablets handed down from Mount COMEX. Here's the problem. That number is lying to you. I don't mean it's a little off. I don't mean it's lagging or delayed or needs context, which is what people say when they're about to explain nonsense. I mean that number is a hallucination. It's a polite, well-dressed illusion designed to keep you calm, caffeinated, and obedient. Let me ask you something uncomfortable. What if the price you're staring at no longer reflects reality? What if it's just a number agreed upon by people who never intend to deliver the thing they're pricing? Because a price without delivery isn't a price, it's a suggestion. Now slow down for a second. Breathe. This isn't a conspiracy rant from a guy in a basement with silver coins taped to the walls. This is a market reality that only shows up if you stop worshipping screens and start paying attention to the real world. Because while you're watching that neat little ticker blink at $71, another silver market is operating at the same time. Parallel, physical, uncomfortable, and wildly more honest. Two prices, two realities, one screen, one street. And the question you need to answer right now is not, where is silver going? It's, which world am I actually living in? Now let me show you where the illusion completely breaks down, because this is the moment when people stop nodding and start blinking. While your screen in New York, London, or wherever you happen to be sitting is politely telling you silver trades at around $71 an ounce, something very different is happening in Japan. Not in theory, not in forecasts, not in could be. Right now. On the ground, in the real market where metal changes hands. Retail silver bars in Japan are trading at roughly 20,000 yen per ounce. Translate that into dollars and you're staring at about $130. 130, not a typo, not a rumor, not a premium you explain away with a shrug and a footnote. So let's do kindergarten math together. 130 minus 71. That's $59. 59. That's an 80+% difference for the exact same metal, same atomic number, same chemical reality. And no, before anyone clears their throat and says, Kevin taxes fabrication shipping, relax. We've all been to airports. We know things cost money to move. Even if you stack every imaginable cost on top minting insurance transport VAT, you might justify $10. Maybe $15 if you're being generous. But $59, that's not friction. That's a fracture. An 83% spread is not inefficiency. It's not stress. It's not markets being weird. It's the financial equivalent of hearing a crack under your feet and realizing the ice isn't thick anymore. Here's the part that should make you uncomfortable. In Japan, buyers are ignoring the $71 price entirely. Not because they're bad at math, because at that price the metal doesn't exist. You can't buy it, you can't touch it, you can't take delivery. The so-called price is irrelevant to them, so they pay $130 without blinking. Not because they're panicking, because they're pragmatic. They understand something very simple. A price that doesn't deliver is just a story. And now we have two worlds operating at the same time. One where silver is cheap, abundant, and endlessly traded on screens, and another where silver is scarce physical and priced like it actually matters. Those worlds are not converging, they're pulling apart. And when markets do that, they don't whisper, they snap. Now let's slow this down and take the emotion out of it for a moment, because panic is useless and math never lies. If you want to understand why this matters, you have to understand what a healthy market actually looks like. In a normal functioning commodity market, price differences exist. Of course they do. A 1 or 2% spread between regions is boring. Nobody even talks about it. 5%, that tells you demand is heating up. 10%, now you're paying attention. That's supply getting tight, logistics straining, inventories thinning. But 80%, that's not a market signal. That's a system failure. Think about it logically. If silver were truly available at $71, banks, traders, refiners, someone with a calculator and a pulse would buy it there and sell it where it's 130. That's arbitrage. That's capitalism 101. That's how markets heal themselves. Yet it's not happening. And that's the clue. People want to blame taxes. Fine, let's talk taxes. Japan has taxes, so does everyone else. They don't magically add $59 to an ounce of metal. Fabrication, sure, bars don't appear by prayer, but fabrication costs didn't suddenly triple overnight. Shipping, please. We move cars across oceans every day. Silver doesn't require a private jet and a bodyguard. Even if I'm wildly generous, and believe me, I'm not known for generosity, you still can't explain more than $10 or $15 of that gap. The rest is something else entirely. That missing $40+ is the sound of scarcity. It's panic hidden behind polite pricing. It's a signal that the paper price and the physical market are no longer speaking the same language. One is quoting contracts, the other is pricing survival. Here's the uncomfortable truth. The so-called spot price is a cash-settled promise. It's an agreement between institutions that assumes metal will be there if someone asks for it. The physical price is what people pay when they actually want the metal in their hands. When those two numbers drift apart, it's noise. When they tear apart, it means the mechanism connecting them has snapped. The pipeline is clogged. The bridge is out. And this is where people make mistakes. They look at an 83% spread and say, "That's crazy, it'll normalize." No, normalization requires flow. It requires trust. It requires metal moving freely from where it's cheap to where it's expensive. What you're seeing instead is paralysis. Metal that exists on paper but won't move. Buyers willing to pay any price because availability matters more than numbers on a screen. That unexplained gap isn't random. It's the footprint of a system under stress. And systems under stress don't bend forever. Eventually they break or they reset. So naturally, the next question people ask me is, "Kevin, if the price difference is that insane, why isn't someone backing up a truck, buying cheap silver, shipping it across the world and pocketing the spread?" And normally, that's exactly what would happen. That's how markets are supposed to work. That's how they keep themselves honest. Banks live for arbitrage. It's clean, it's boring, it's repeatable. Buy low here, sell high there, hedge the risk, collect the spread, go home early. No drama, no speeches, just math. If this were a normal market, that trade would already be crowded, the gap would close, and we wouldn't be having this conversation. But this isn't a normal market. And arbitrage isn't just sick, it's clinically flatlined. Here's why. First, logistics. Physical silver doesn't teleport. It has to be sourced, secured, insured, shipped, cleared, and delivered. And right now, those pipes are clogged. Refining capacity is tight. Secure transport is limited. And moving serious volume isn't a quiet operation. It's a spotlight that triggers scrutiny, delays, and risk nobody wants. Second, refining. You can't just grab any bar and call it good. Different markets require different specifications. Converting large bars into retail-ready metal takes time, capacity, and trust in the supply chain. When demand explodes and capacity doesn't, the bottleneck becomes the price. And then there's the big one. Nobody likes to say out loud, default risk. If you try to pull millions of ounces out of the paper system, you don't get applause. You get resistance, margin calls, delays, and eventually the magic phrase, cash settlement. That's when you learn the difference between owning silver and owning a promise. This is where the market splits in two. On one side, you have the paper world. Silver is abundant. Trades settle instantly. Charts look bearish. Algorithms hum along happily. Everything is clean, digital, and detached from reality. On the other side, you have the physical world. Silver is scarce. Delivery takes weeks. Pricing goes vertical. And availability matters more than theory. These two worlds used to be connected by arbitrage. That bridge is gone, burned, collapsed. Pick your metaphor. And once that happens, you don't have one market anymore. You have two realities coexisting, pretending to price the same asset. One trades contracts, the other trades survival. Banks are trapped in the paper world because that's where their balance sheets live. Retail buyers and industrial users are trapped in the physical world because that's where their needs live. And nobody can easily cross between them without blowing something up. This isn't a temporary glitch. It's a structural bifurcation. And history is very clear about how this ends. When paper and physical diverge long enough, paper doesn't win the argument. Reality does. Now, let me slow everyone down before this turns into another end-of-the-world slideshow with dramatic music and red arrows pointing at bank logos. Because here's the part most channels get wrong, and frankly, it annoys me. This is not a story about banks collapsing tomorrow morning. It's not a story about ATMs shutting down or suits jumping out of windows. If that's what you're waiting for, you're going to be disappointed and probably mispositioned. What we're dealing with here is not insolvency, it's liquidity stress. And those two things are not the same no matter how badly YouTube thumbnails want them to be. Insolvency means you're broke. Liquidity stress means you have assets, but you're juggling cash timing. One is a heart attack, the other is high blood pressure. Both are uncomfortable, but only one kills you outright. Large banks are not fragile mom-and-pop shops. They sit on hundreds of billions in Tier 1 capital. If silver moves from $71 to $100, yes, paper short positions take losses. Big ones, billions. That hurts. It ruins bonuses. It causes very tense board meetings. But it doesn't vaporize institutions overnight. And here's where the narrative gets lazy. People assume losses equal collapse. They don't. Losses trigger adjustments, repositioning, retreats. Banks don't panic the way retail traders do. They manage damage. They hedge. They slow things down. They change behavior. That's exactly what you're seeing now. This isn't a surrender. It's a controlled withdrawal. Suppressing silver at $20 was cheap. Suppressing it at $70 isn't. The math stops working. So they step back, let prices rise in stages, manage margin, exposure, and wait for volatility to do what volatility always does, shake out leverage. That distinction matters. Because when you mistake a liquidity event for a solvency crisis, you start making reckless bets. You start chasing leverage. You start believing collapse is imminent instead of structural change being underway. And that's how people get wiped out while being technically right. Banks aren't dead. They're adapting. They're still powerful. They still influence paper markets. But they're no longer in full control of the physical flow. And that's the shift you need to understand. This isn't a movie explosion. It's a slow, deliberate repositioning. And those are far more dangerous because they don't look dramatic until it's too late. Now we zoom out, because if you think this is just a quirky pricing anomaly in the silver market, you're missing the bigger picture. This stops being a finance story the moment geopolitics walks into the room. And right now, geopolitics has both feet on the table. Silver is not just an investment metal, it's an industrial metal. It's strategic, and no country understands that better than China. China sits at the center of the global refining and processing chain, not just mining, but turning raw material into usable industrial-grade metal that feeds solar panels, electric vehicles, electronics, medical equipment, and defense systems. Silver isn't jewelry in that world. It's infrastructure. Now imagine what happens when a country like that decides quietly and bureaucratically to change the rules. New export licensing, priority access for large state-aligned refiners. Domestic needs first. On paper, it sounds reasonable. In reality, it functions like a choke point. Smaller refiners get squeezed. Scrap recyclers get boxed in. Traders lose flexibility. And suddenly, what used to flow outward stops flowing at all. Here's the key point. When domestic consumption exceeds production exports, don't slow down. They disappear. Not with a press conference, not with sirens. They just don't show up anymore. And Western markets that quietly relied on that supply wake up one morning realizing the tap isn't dripping. It's dry. This triggers a chain reaction that has nothing to do with speculation. Industrial buyers don't care about charts. They care about continuity. If you run a factory and silver is mission-critical, you don't wait for confirmation. You hoard. You overorder. You secure inventory far beyond immediate need, because shutting down a production line is far more expensive than paying a premium. That behavior alone creates phantom demand, not because consumption explodes overnight, but because fear changes ordering behavior. Just-in-time supply chains collapse the moment trust disappears. And once that happens, paper contracts become meaningless. A futures promise doesn't keep a factory running. Physical inventory does. Here's where it gets uncomfortable for Western markets. While China secures its domestic needs and continues operating, everyone else competes for what's left. Japanese buyers pay whatever it takes. European manufacturers scramble. North American inventories drain quietly, and none of this shows up cleanly on a price chart until it's already done damage. Banks can influence paper prices. They can't manufacture metal. They can't override export policy. And they certainly can't force sovereign supply chains to behave in their favor. When a structural supply shock enters the system, financial engineering takes a back seat to physics. This is why I keep saying this isn't short-term. You don't unwind geopolitical realignments in a quarter. You don't fix industrial shortages with a rate cut. New mines take years. New refining capacity takes time. Recycling is already maxed out. Strategic stockpiles don't appear overnight. So when people ask me, will this blow over, my answer is simple. No, this is a reordering, and reorders don't reverse quietly. They grind, slowly, relentlessly. And while everyone argues about price targets, the real battle is being fought over access. Who gets the metal? Who doesn't? And who wakes up one day realizing that the supply they assumed was always there isn't anymore. Now let's talk about the clock. Not the one on your wall, the one nobody wants to stare at, because once you see it, you can't unsee it. The COMEX inventory clock. People hear inventory numbers and their eyes glaze over. Big mistake. This is where the story stops being theoretical and starts becoming uncomfortable. Because not all silver sitting in a warehouse is the same thing, no matter how badly people want to lump it together. There's registered silver and there's eligible silver. Registered means it's ready to be delivered. It's tagged, approved, and legally available to satisfy contracts. Eligible means it exists, but it belongs to someone else. It's private property. It's not for sale unless the owner decides it is. That distinction matters more than most people realize, because when you look at registered silver, the pile that actually backs the paper promises you're not looking at a mountain. You're looking at a hill, a shrinking one. Global silver consumption runs around 3 million ounces a day. That's industry electronics, solar, medical, real usage. Not speculation. Not trading games. And when you line that up against registered inventory, you start realizing something awkward. There aren't months of supply sitting there. There aren't even weeks. There are days. Now here's where people get sloppy. They point to eligible inventory and say, "Relax, there's plenty of silver." No, that silver is not a communal fridge. You don't get to open it just because you're hungry. Those ounces belong to private holders who have zero obligation to deliver them into a stressed system, especially when prices elsewhere are screaming higher. So what happens instead? Registered inventory gets drained. Slowly at first. Quietly. No headlines. No panic. Arbitrage players and industrial users pull metal because they still can. And every ounce that leaves registered inventory tightens the noose just a little more. This is a war of attrition, not a bank run, no crowds, no shouting, just metal leaving and not coming back. And the irony, the lower the paper price stays, the faster that drain can accelerate. Cheap paper prices make physical accumulation irresistible for anyone who understands what's happening. That's why this feels calm on the surface. Charts look boring. Volatility comes and goes. But underneath the system is bleeding inventory. And once registered inventory hits a critical threshold, the rules change. Deliveries get delayed. Cash settlements get encouraged. And the idea of a single reliable spot price starts to break down completely. This is the window most people miss. They wait for headlines. They wait for explosions. But by the time everyone agrees there's a problem, the metal is already gone. So when I say the window is closing, I don't mean tomorrow morning. I mean quietly, methodically, one delivery at a time, and markets don't rewind when they hit zero. They snap. So where does that leave you? Not panicking, hopefully, because panic is expensive, and leverage. Let me be very clear here. Leverage is a gift to the system that's designed to shake you out. If there's one mistake people make in moments like this, it's believing they can outsmart volatility with borrowed money. You can't. Margin calls don't care how right you are. They care about timing, and timing is never on your side when the system is stressed. This is why I keep drawing a line between paper and physical. Paper is convenient. It's liquid. You can click a button and feel productive. But paper is also a claim, a promise. And in a world where delivery is the bottleneck, promises get repriced brutally. Physical metal is inconvenient. It has storage costs, insurance. It doesn't fit neatly into an app, but it has one unbeatable advantage: you control it. Now let's talk about the end game, because every system has one. When registered inventory approaches zero, the spot price stops being a reference point and starts being a suggestion. Deliveries get discouraged. Cash settlements become generous, and anyone holding claims learns a very old lesson about the difference between owning something and being owed something. This doesn't happen with fireworks. It happens quietly, then suddenly. One day the price gap snaps, not because sentiment changed, but because reality caught up. That's when people say, "I wish I'd acted earlier," which is just another way of saying they waited for certainty in a system that never offers it. So the strategy isn't heroic. It's boring. Avoid leverage. Accept the trade-offs. Own what you can control. Be patient while the grind plays out, because this won't move in a straight line. There will be drops designed to test you, rallies designed to tempt you, and noise meant to exhaust you. At the end of all of this, the lesson is simple and very old. Markets can manipulate numbers. They can stretch narratives. They can delay consequences. But they cannot rewrite physics. Scarcity always wins. And when it does, the people who respected reality early don't need to rush. They're already where they need to be.